Reminder. Yeah. Thank you. Yep. Apologies. Yep. Okay. So if we, all right, thanks. Yeah. Yeah, should record it. Because today is I will try to go over two of the chapter, although it's the shortened one, so don't worry too much about it. So if we focus on the closed economy, right? Closed means what? Closed means no trade, right? So if we focus on closed economy, GNE, one of country's GNE gross national expenditure, it's equal to consumption plus investment plus the government spending, right? Because this country is closed, right? If we assume this country is closed, this is actually equal to the GDP of a country. Okay? So the total output in one of the country could be absorbed by three different categories of the expenditure, right? So output, the final goods produced by the domestic firms, they can be absorbed, yeah, absorb, PD, yep, absorbed by three different categories. So one is consumption, one is investment, and one is government spending. Okay, so let's review a little bit of the what's the idea of the GDP. So macroeconomy, the textbook will tell you GDP is the value of all intermediate and final goods and services, right, produced, output by the firm. Okay, minus the value of all goods and services purchased as an intermediate input by the firms, right? So in the short term, what does it mean? We calculate the value added in the final goods of a country, right? So if I have more output, suppose I have a more output, my GDP is supposed to be higher, right? Okay, and the last term is called GNI. So what's the gross national income? In closed economy, income is paid to domestic entities. It thus equals the total income versus of the economy, also known as the national gross income. So as you could see, three of the ideas, they're supposed to be correlated with each other, right? So whenever we say expenditure, national expenditure, or the total production, or the income, they should somehow, you know, as an indication of the total income or total output of a country, right? So the higher it's better. Okay, so we want to take a deeper look of what's the differences between those terms in this chapter. So the books just tells you if I aggregate consumption, investment, and the government spending, this is my national expenditure, right? And then if I added the value added of the goods, this becomes domestic product, right? And in order to produce the goods, I need to put in some of the production factors. And those factors, for example, the capital rent, okay, or like the rent on land, or the wage of the laborers, is supposed to be counted into the national's economic production. So if I add those two things, this becomes GNI. Okay, so the measurement of the national expenditure, product, and income are recorded in the national income. Okay, so national income and product account with the major categories shown. Okay, purple line shows the circular flow of all in a closed economy. So remember, this is a closed one. So you didn't see anything related to like export or import, right? But we are going to add those two later on in the model. Okay, so now we switch our attention to the open economy. Okay, so now we need incorporating one of the term called BOP, the balance payment account. So in a simple word, BOP could be treated as like a trade balance. Okay, so what's the trade balance? The trade balance is the differences between the payment made for the import and the payment received for export. It's called the trade balances. So remember in trade chapters, we define this one as this before, right? So X is the value of the export. That means usually means the payment that you receive, right? So value of the export. This one usually is equal or identical to the payment you receive from foreign country, right? The foreign country we look at here, foreign country means the rest of the world, okay? And M, on the other hand, it's the value of the import goods, right? So value of the import goods, on the other hand, supposed to be not your revenue, right? Not your payment received. Supposed to be the payment you made for import goods. Okay, so now by the definition of the Simon-Kuznets definition, the GDP in the open economic country, right, in an open economic country or open economic entities, GDP is equal to the gross national expenditure plus trade balances. Okay, so this is the first important equations that we are going to explore today. Okay, so if you go back to a macroeconomics textbooks, no matter which book you use, you definitely already learned this one before, right? So what is y equal? So you're supposed to learn y equal to c plus I plus g plus mx minus m before, right? So this is the national income, right? National income or national output. And this is equal to, this is called GNE, the consumption, right? The private sector's consumption, private sector's investment, and government spending. And the last part is coming from the international sector, right? So this, we call it trade balances before. And later on, you will have a new name called current account. Well, it's not necessarily the same, you know, like, because we have a lot of goods right now. So current account will be the trade balances in the goods. And there are two other accounts we are going to discuss later on. So all you need to know is GDP equal to GNE plus trade balances in open economic setting. Okay, and then we need to take the factors income into consideration as well, right? So we are not only doing the trade in goods, we also doing the trade in services. For example, you hire the people outside of the US, so you have to pay the wage to the foreigners. So now, what do we need? Does that count into your national account for the economic growth or not, right? So now we need to count two more things here. So this is called net factor income abroad. So everything that started with the net means it's the export minus import, or the differences between the exports minus imports. Okay, so the factor income from abroad, NAFIA, is the value of the import factor services. This is a minus term, plus the value of the export factor services. So for example, what is this one? So say that right now, one of the US citizen was hired by the Chinese government to build out a factory, and he received the payment from the Chinese firms, right? So US export labor to China and receive the payment. This is called the export of the factor services, right? On the other hand, for example, I'm the citizen from Taiwan, right? And I was hired by George Washington University. So George Washington University pay the import of the factor, right? So it's me, so it's labor to me. So this is the minus term for the U.S. Uh, gross domestic product. No, the national account, right? So GDP plus NFIA, it's equal to GNI. Okay, so two equation we have already explored. The first one, GNE plus trade balances is equal to GDP, right? And the second one is GDP plus NFIA is equal to GNI. And one more thing we need to consider, it's called transfer. Okay, so transfer means what? Transfer means non-market transaction. So you can treat it as the gift, right? It's something not related to your production, but you still get it. So for example, during the financial crisis, World Bank or IMF, they will give some of the packages to the countries that are involved in the crisis. So that's a kind of the transfer. Or some of the country, when they participate into the international organization, you are going to be asked to donate some part of the fee, right? So that's kind of a transfer, not directly related to the pro production activities. You didn't sell anything, you just move your money from your country to another country. Okay, so that's called a transfer. Usually, this is a very small amount of the. It's very small amount if you compare with the GDP and GNE or the other account. So this is called net unilateral transfer. Okay, so NUT is the acronym equal the value of the unilateral transfer the country receive. Okay, so the money that you get, right? The money that you get from the rest of the world, so foreign country, give it to you, minus those you give it to the rest of the world. Okay, so how do we add those terms up? So let's review one more time. So what's the first one? If I'm in a closed economy, GNE is equal to the sum of my consumption plus investment plus government spending, right? So this one, if I move to trade balances, if I move to the open economic setting, I will have the trade with people, right? So the trade balances means the goods, the payments that are the result of the trade in goods, right? So this will give me GDP, okay? And then secondly, GDP plus NFIA, right? The factors trade in the services, right? So this is the trade in goods. In goods. This is the trade in services. Usually it's the labors, right? NFIA. So this is equal to the gross national income. Okay? And the third layer is the transfer, right? Like the gift you get, the net gift you get, or you give into the other country. You add GNI by NUT, net unilateral transfer, you will get gross national disposable income. Okay, so this represents all the money that the countries have. Okay, if you first time to see this one, you will feel a little bit overwhelmed. It's okay, but the logic behind is like what I said, right? So beginning, the three different categories that we have in the domestic absorption is the consumption, investment, and the government spending, right? Without dealing a trade, without doing business with the other countries, if you're locked down by yourself, that's all you have. And then we know trade is one of the important things, right? Trading goods is one of the important things. So this is the original equation, right? That's the definition of the GDP. The gross national expenditure plus the trade balances is the GDP. And then GDP plus the factors, right? The income you pay for the minus the income you pay for the foreigners plus your citizens' income get from the foreign country. That's become your GNI, right? And the last one, the gifts from the other country, the donate you made to the other country, their balances, right? So GNI plus NUT, that's equal to the one we care the most. That's called the gross national disposable income. Okay? But usually, like if we move to chapter 18, we will assume GNDI just equal to GDP. Because of what? Because of the transfer, right? The transfer, unilateral transfer is relatively small, and the factor, the services payment, is relatively small. Majority of the trade involved in the goods market, right? So we usually will assume this is the case, and we will see it in the second half of today's lecture. Okay, so I think I already explained this one. Okay, and then two other things is called the financial account and capital account. So they are the other two factors in the balance of the payment. Okay, so let's take a look. What is this? So the value of the asset export minus the asset import is called the financial account. Okay, so the money inflow and money outflow. Okay, the net asset export are added to home GNDI when calculating the total resources available for expenditure in home country. Okay, so this one is a positive term as well. So GNDI plus FA. This is what we have right now. Okay, the last one is the capital account. Okay, so capital account, a country may not only buy and sell assets, also transfer assets as gift. So this one will be the capital account. Okay, which is the value of the capital transfer from the rest of the world minus those to the rest of the world. So US, right? US and the rest of the world, you send out your money as a gift, right? So this is your transfer, and this is the transfer that you have, right? So the one you receive minus the one you give up is the capital account. Okay, so that's the whole idea of this flow. Okay, so let's see. Measurement of the national expenditure, product, and income are recorded in the national income and product account, with the major categories shown on the left. Okay, so it's here, the purple one. Measurement of the international transaction are recorded in the balance of the payment of the account, with the major categories shown on the right. Right? So you can see what's the difference between left-hand side and the right-hand side, right? So this one, it's usually the money flow. This one, it's usually the goods or product flows. Right? So this somewhat echo to our course, right? Remember why we call international, why we need to learn international trade and international finance altogether. It's because of the core of the transaction, right? If you sell the goods, right? If you sell the goods to other country, the other countries people needs to pay you money, right? So goods in return for money. Okay, so one transaction will have two flow. One flow is in the goods, one flow is in the asset or money, right? It's the same thing whenever if you do the opposite, if you buy the goods from the other country, you buy the goods and you have to pay out the money back to them, right? And the first part of our lecture, first part of our course, focus on the trade, which is this one, the good flow. So trade, right? And the second one is the finance. Okay, so we have three different approach to measuring the economic activity. Okay, so one is called expenditure approach. Okay, the key measure is GNE. The second one is product approach. The measure is GDP. And the last one is the income approach. Okay, and the key measure are the GNI, G, and DI. Okay, so from the GNE to GDP, somehow I already told you, right? So GNE, what's the definition of the GNE? Consumption plus investment plus government spending, right? So the first term in the long term in a long formation is called personal consumption expenditure. Right? Usually we call it consumption. It's equal to what? The total spending by the private household. So this is in the private sector on the final goods and services. Okay. Also, this including non-durable goods, durable goods and services. Secondly, investment. Spending by firms or household on the final goods and services to make addition to the stock of the capital. So what does it mean? Means the money you spend, for example, money spending on building on the factory, building the factories, buying the equipment, or paying the rent. So investment, you should know like what does it mean. Okay, and lastly, it's the government expenditure. So unlike in the consumption, government expenditure, it's in the public sector, right? So what is the government expenditure? Equals the spending by the public sector on final goods and services. Okay, so include the spending on the public works. So for example, building up a new school, building up the new infrastructure, building up the roads, and the military, right, and national defense. That belongs to the public sector's expenditure, right, the police and civil services. Okay, it does not include any transfer payment or income redistribution, right? So for example, the Social Security does not count into this category. Okay, so now we already know the definition of consumption, investment, and government spending. Okay, so last two part, it's called the trade balances. Okay, so this it's our offer, right? So what's the meaning of the export? You sell the goods from the domestic market to the foreign market, right? So this it's the exporting goods. Remember, this is the value of the exporting goods. Okay, so let's turn the unit it's dollar, this unit is dollar, unit it's dollar. This one, the unit is also the dollar. If we focusing on the U.S. national account, whereas the import is going to be a minus sign, right? Because import means these goods are not produced by your domestic firm, so you buy it from the foreign firms, right? So this is the payment that you pay to buy the foreign goods. So this is the value of foreign goods, imported foreign goods. Okay, so those two terms, the combination of those two terms, we give it a term that's trade balances. Okay, so like we said in the beginning of our lecture in late June, the trade balances is larger than zero. So what does it mean? This is larger than zero. That means export minus import. It's larger than zero. So that means export it's larger than import. Right? So what do we call this one? If the export is larger than import, we call this country enjoy the trade surplus, right? And in the mercantilism, right, one of the old school in economics believe that export is the good thing because you have more money if you sell your goods to the other country, right? On the other hand, what is the trade deficit? By its definition, is the trade balance is a negative term. So if we go back to the definition of the trade balances, export minus import, right? This term is smaller than zero. So this means export is smaller than import, right? Means the goods that you sell to the rest of the world, the goods you sell to the rest of the world, it's smaller than the goods buying from the rest of the world. Okay? So this is the most important thing, right? So GDP, this equation, GDP is equal to GNE plus trade balances. What's GNE? GNE is the sum of consumption, investment, and government spending, plus the trade balances. The trade balances is equal to the value of the exporting goods minus the value of the importing goods. GNI, okay, GNI, we need to take into the factor into account, right? So this, we could write it as this, right? So gross national income, it's equal to gross domestic product plus net factor income from abroad. Okay? And what is this two term? The exporting factors, right? The US citizens, the higher, right, the wage that they get from the foreign country, the firms in the foreign country, foreign firms, right? So this could be, for example, the NBA players play in the Chinese basketball league, right? Players' salary, pay, right? What about this one? It's just the opposite, right? So the foreigner coming to the United States and then get a payment by the US company. So like um, foreign scholar by GW. Right? So as you can see, this one is the result of the trading goods. And this one is the result of trade in services. Okay? So if you have this idea in your mind, this becomes very straightforward. Right? So the gross national income, not only you need to count the goods, but also you need to count the factors, like the labor migration between a country. Right? Some people work different from the country they was born and raised. So you will have this term. Right? So the international migration of laborers play a part in the international trade as well. Right? So you need to count. If you use the broader definition of your national account, like GNI, you need to take into account of those factors as well. So lastly is the NUT. Okay, so country receive a transfer, right? So this is the transfer that you receive. They use UT in. Okay, the money that you get from the international organization. This one is the money you pay to the international organization, right? For example, if you want to join United Nations or you want to join World Health Organization, you need to pay a certain amount of fee in order to keep your membership of that international organization, right? So two payments differences is called net unilateral transfer. Okay, so this unilateral transfer is not directly related to the production, right? So you didn't engage in any kind of the production process. For example, it's not because you made something and you sell on the market, so you get those transfer. It's simply just because you move your money from in the country to outside of the country, or it's you receive the money outside of your country. That's it. Okay, so this is the broader term, right? So this is called the gross, right? Gross means total, right? National disposable income. So it's GNDI, right? So this is equal to first term GDP plus NFIA factors plus NUT, right? That's it. And the second term, if we combine GDP and NFI, we already know this one is GNI. Okay. Okay, so now we take a look what is the current account. Okay, so here it's just another definition. So this one is called gross national domestic income. Right, so the total income of this country is expenditure, domestic expenditure by three parts, right? Consumption, investment, and government spending, domestic expenditure. And this one is the trading goods, trading services, that's it. So on the left, it's our full income. Okay, so that's the broadest, like the widest definition of the national account. Okay, so this is equal to, I don't want to repeat one more time. So it's larger than GDP, larger than GNE. Okay. Okay, GNE is the measure of the home entities. The remaining terms measure the net payment to the home country from all international transactions, goods, services, and income. Okay, so the current account, it's this one. Okay, so the full name of the current account is supposed to be the current account of international trade. Okay, so that include what? Include the trading goods, include the trading services, include the transfer. Okay, so now we know that the broadest, the widest definition of the national account could be right as this. Okay. Okay, so this just you.
I'm still copying. It's all right. Let's keep going. I'll go to the recording.
Okay, yeah, sure, yeah. If you have a question, just let me know. You know, this is just the terms. This is just the definition of this. This chapter is called accounting, right? So you know, like accounting things, you have to know what is the name of the category first. That's the idea. We try to build up the national account. Not so many economics implication here. Okay.
Yep. Okay.
Yeah, or you could just type up your question and let me know.
No, it wasn't a question, Jeffrey. I was copying what you were writing.
Oh, okay. Apologies. Okay.
I'll go back to
It's
the
okay.
recording.
So it's okay. It's okay. So it's alright. Yeah. Let me write it up one more time. So
Okay, I'll go to the recording. It's okay.
yeah, it's just going. Here. It's just GNDI, the last one, right? It's equal to the domestic expenditure, GNE. So this one is domestic expenditure. And plus current account. And I write like current account, the full name of the current account, right? CA. It's current account of international trade. That's it. Right? If you think about that, if you are in a closed economy, so you are not dealing a business outside of your country. So you won't have the trade balances turn. You won't have the net factor income from the bar. You won't have the transfer, right? So this is domestic, and this is international, and this is current account. And current account is measured by the product level, right? Like the services that you've done, how many product you receive, like the gift you receive minus the gift you donate is the product. And two other accounts is called financial account and capital account. They are on the opposite side of the current account. So CA should equal to minus those two. Okay? This is called balance of identity. We will have one of the slides. It's just typically focus on this one. Just hold on a second. Okay. Okay, so this is just give you an example, right? So now if you know all of the categories of the, like if you know all the values of each of the categories, then you should be able to calculate out the GDP, GNI, and GNDI. Okay. So once again, what is GNE? The first equation we see today, right? So GDP is equal to GME plus trade balances, right? So what's GNE? GNE is the sum of consumption, investment, and government. So CIG, their sum is equal to GNE, right? And then we move on to the open economy, right? The trade balances, we add trade balances. If we add trade balances, GNE plus trade balances, that's equal to gross domestic product, GDP, the famous GDP. Yeah, Jack, yeah.
I assume that this is something that's going to be on the test. Yes,
well,
okay.
at least you need to know some of the terms, right? Like the first one, like the second one should be, yeah. But in very simple ways. Maybe I could give you like one of the table like this, and you need to calculate out the GDP. Is it?
Calculate the what? You cut out. Sorry, you cut out.
Like the GNI or GNDI. So if I give you every single small category, right? So, like for example, I give you C, I, G, and TP, and FIA and NUT. So now you're supposed to calculate all the GNDI, right? So this is just the operation, right? Just the add up and the minus, just the accounting, right?
Right.
We got accounting majors people here, so yeah. Yeah. So accounting, right? So you just add something and it's that's it. Yeah.
No, I got it.
There's no any other models, like. Yeah, but this one is necessary because we need to introduce the idea of the BOP, and then we could move on to the ISLM model in the next chapter. Yeah. So, is it okay? It's a take-home exam, so you could refer to the table here, or you could look up all the definitions. Yeah. Okay, so this is just give you the example, right? So if you know the total consumption in a country is like here, so it's like $12,272, right? Maybe it's billions. So here it's billions. right? If you know the consumption is equal to this, you know the investment is equal to this, you know the government spending is equal to this, then you should be able to calculate out the G&E, right? So if you have one additional information on the trade balances, so now if you have the information of C, I, G, and trade balances, you should be able to calculate out the GDP, right? And if you have know the net factor income from the above, you should be able to calculate out the GNI, so gross national income. One last term, if you know the transfer, right, net transfer, you should be able to find out the gross national disposable income. Okay. All based on those three equations, right? So this is the first one. Okay, maybe let me use whiteboard to go over it one more time. Okay, so the first equation you need to know is GNE. This is stand for gross national expenditure. Right, so this one is equal to consumption plus investment plus government spending. Second equation, counting equation you need to know is GDP, right? We are living in an open economy, right? So this one, this term is called right? So if you expand it out, this one is equal to okay, and the third one is called GMI. I remember one term we added in, it's called NFIA. This one is the net factor income from abroad. Right? Lastly, GNDI is equal to GNI plus NUT, net unilateral transfer. Right? So we say that either this could be treated as a national account. Right? What's the national account? It's the measurement of economic activity of a country. Right, so if you take one more look, and here's GNE, GDP, here's GDP, GNI, here's GNI. Right, so this is GNE, this is GDP. GNI, that's it. Is this clear? Right, so this is closed econ, right? This is open econ, added service trade. Plus transfer. Right? So I might give you like very simple table containing all the information in a small category. For example, consumption, investment, government spending, and then trade balances. Then you should be able to tell me what is the GDP and what is the GNE. Right? Basically, just follow the equation, follow the definition of each of the terms. Okay. Okay, and then we move on to. Can I switch back to the lecture slides? Okay, great, thank you. So, okay, yep. So let's see. Okay, so current account, right? So current account, we know this is equal to trade balances, right? Plus NFIA plus NUT, right? All related to international, right? Current account of international trade, trading goods, trading services, transfers. All right. Okay, so this equation is called the open economy national income identity. It tells us that the current account represent the differences between national account Y. Okay, so here, Y, gross national expenditure, this. Y. If we use mathematical representation, right, so Y is equal to, right, and then Y minus C minus I minus G is equal to this. That's the idea of this statement. Okay, so if GNDI is greater than GNE, so GNDI, gross national domestic income, the gross national disposable income is larger than this return, larger than expenditure, I have a positive turn here, right? So that means what? That means the current account of the international trade is larger than zero as well. Right? So you see here, the condition, the logical statement here is if and only if, right? It's sufficient and necessary condition. If CA is positive, current account is positive, that means the gross national disposable income is greater than gross national expenditure, right? And the other way around, it's as well. So if this one, GNDI, gross national disposable income, is greater than gross national expenditure, then I'm sure that a current account is positive, right? And by this mathematical representation, you should be able to see it clearly, right? Let's do it one more time. What about GNDI is less than GNE? So what does it mean? So GNDI here is equal to Y. GNE is equal to C plus I plus G, right? So GNDI is less than, so GNDI less than GNE. So GNDI minus GNE is smaller than zero, right? Expand it out. Y minus C plus I plus G smaller than zero. This implies current account smaller than zero. Okay, so current account is positive if GNDI is larger than GNE, right? So use a plain word to say it. Income is larger than expenditure. My account larger than zero. If the income is smaller than expenditure, my account suffer a deficit. Okay? Good. Okay, so now we define another called national saving. Okay, so this, right, minus the spending, expenditure, okay, not spending, expenditure in private sector. This is the G is the expenditure, government spending, right, in public sector, right? So what is this? This is the national income. Y represent national income, right? And national income minus consumption is the expenditure in private sector minus the expenditure in the public sector. So we give an N, it's called national saving, right? So saving is equal to income minus 2 expenditure. Okay, so if we plug in Y, Y is equal to C plus I plus G plus CA, right? And S is equal to Y minus C minus G, right? So what is this one? What is S? Remain. CG will cancel out. I will have investment plus current account, right? This will give me this equation, right? So saving is actually equal to the investment plus current account. So, on the other hand, think about that. What does the current account mean? The current account actually could be defined as the differences between the saving and investment, right? If saving is larger than investment, CA is larger than 0. All right, and in this case, we call surplus, current accounts in surplus. If, on the other hand, if S is less than I, if CA is CA will be negative. And we call it current accounts in deficit, right? So just manipulate the accounting equation here, right? I define a new term called S. I define a new term called X. That's called saving, right? And by given the definition of a saving, I know saving is equal to the investment plus the current account, right? And then using the algebra, I know current account is equal to the differences between saving and investment. So that if I compare the magnitude of the saving and investment, I can know current account it's in deficit or in surplus. Okay? Is this clear? Good. Okay, so let's see, like in another term, it's called financial account. Okay, record a transaction between the residents and non-resident non-involve the financial asset. Okay, so this definition covers all types of the asset, real estate such as land and structure, financial assets such as debts like bonds or stocks or loans or equity issued by any entity. Okay, so I have current account, right? So remember, current account, it's from the perspective of the product. Now we shift our attention to the money side, transaction. Right? Remember, a transaction means you exchange your product with the money. Now we already finished constructing the current account. We need to move to the financial account and capital account. That's what we are doing here. Okay, so financial account, okay, what is this? Subtracting the asset import from asset export. Okay, so this yields the home country's net overall balance on asset transaction. Okay, so this are the goods they are looking at, and the goods are money, right? So you could treat it as like money is a very typical, like a different, unique good. It's the movement, this is the flow of the money, in some sense. Okay, so the financial account measure how the country accumulates or decumulate assets through international transactions. So as you could see right now, what is the relationship between CA and FA? they should be something like this, right? If you have the surplus in a current account, you should have a deficit in financial account, right? If your export is larger than your import, that means you get the money from the outside of the country more, right? So their relationship should be somewhere equal to this. This is true. Plus, we need to consider another term. It's called capital account. So this one will be the identity that plays the central role in this chapter. All right, if you see, CA, the left-hand side current account capture the product flows. Right-hand side capture money flows. That's it. The rest of the materials are just the definition. So what's capital account? Capital accounts cover two remaining areas of the asset movement. Okay, so capital transfer, acquisition and disposal of the non-financial and non-produced asset. Okay, so copyright, trademarks. Okay. Okay, so let's move to this chapter. This slice. What is the BOP? Okay, so BOP is from a macro perspective. Okay, so so CNE. Need to go over that one. Okay. Okay. So let's take a deeper look of the financial asset. So from home perspective, a foreign asset is a claim on a foreign country. Okay, when a foreign home entity holds such an asset, it is called external asset, okay, of a home country. Okay, so for a home entity holds such an asset, it's called an external asset of the home country. So like holding U.S. Citizen holds the house in UK, right? External asset. So from a foreign perspective, a foreign asset is claimed on a home country. When a foreign entity, right, entity, household or firm, holds such an asset, it's called an external liability of the home country, right? If the foreigner have the real estate in the United States, from the country's perspective, this is called external liability. Okay, so the foreign account, the financial account is like this. Net export of the home asset plus the net export of the foreign asset. Okay. Okay, the FA equals the addition to external liabilities minus the additions to external asset. Okay, so all it leads to this equation. Okay, so leads to this equation. This is the most important equation. CA plus KA plus FA is equal to 0. That's related to international economy. BOP identity. In other way, it means this equation should always hold. Yeah, so for me, I just interpret it as this is the goods flow, right? And this part means the money flow, right? And if you remember the basic idea of the trade, every transaction involves the product and money. Right? If you have the deficit in product, that means you have the surplus in money. That's the idea. So balance payment identity, BOP identity, is equal to this equation. Okay. Lastly, two other terms, BOP credit and BOP debit. Okay, so if CA plus KA plus FA is larger than 0, we call this country as a BOP credit. So it's a balance of a payment creditor for this country. If this country has a CA plus KA plus FA, so we call it BOP debitor. Okay, so the most important things you need to know in this chapter is first, different measurement of the national account. Okay, so accounting means you need to know a lot of the terms, right, in a national account. Then understand what's the meaning of the BOP and what is the BOP credit and debit mean for this chapter, right? So this chapter is just paves a path for us to get into the new Keynesian model that we are going to explore in chapter 18. All right? So this will be the end for chapter 16. Most of the terms are just the definition and category, and not so many economic meaning inside. So if you think it's a little bit too much, maybe go over the textbook one more time and then go over the lecture slides one more time when you have time. So let's move to the chapter 18, which is the last chapter that we are going to discuss in today's lecture. And it's the last one. It's the last one. It's the last chapter in our whole course. Okay, so this one, we are trying to explore one of the most important model in, I don't know why this become like this. The topic of this chapter is the balance of payment So output exchange rate. And macroeconomic. No, no. Policy. In a short run. So the most important model we are going to see here is called ISLM, FX model. Okay, but it has a lot of name of this model. Okay, some people will call it ISLM, BP. So BP is the short term called BOP model. Some people will call it extension, new Keynesian model, or it's accredited to named after the two well-known economists. It's called Mundell Fleming model. Okay, so it combines what? It combines the goods market equilibrium condition, money market equilibrium condition, foreign exchange market equilibrium condition. So the general equilibrium model of those three market. Okay, so let's start with the assumption of this model. Can you guys see this one clear or not? Like, it has a problem, right? So
No, I can't.
yeah, hold on. Give me 1 second. Give me 1 second. Let me fix it. That's the reason why I need to convert it to PDF, which I didn't for the last one. Let me see. Share the screen. Here we go. Now you can see it, right?
Yes.
Like it's clear.
Yep.
Yeah, sorry about that. But I need to give up my pen. Ah. I can't draw it anymore. That's weird. Okay. So why don't we take like 5-minute break? Is that okay for everybody? Let me try to fix it, because I just need to convert the PowerPoint slides to PDF and then re-upload it again. That everything will be fine. But sorry about that. Yeah, I really want to cover this one. So okay, so we're back at 7:42. 7:42. Okay, let's get back. Really sorry about that. I didn't convert it to the PDF this afternoon. Okay, so let's move on to the chapter 18. So we are going to look at one of the most important in international economics called the Fleming model. The Fleming model. Okay, so this is named after two well-known economists. This is Robert Mundell and Marcus Fleming. And because this is the extension of the Keynesian model, so some people call it extensive or extension Keynesian model, or some people call it Keynesian model in open economy. So basically, it combines three different money equilibrium conditions. The first one is the good market equilibrium condition. So all the concept that we are going to use is in chapter 16. So this is based on the Kuznets. So Simon Kuznets, National Accounting. And the second one, money market equilibrium. This is based on chapter 13, 14, 15. Okay, CIP, UIP, and PPP. Okay, last one. This is just the UIP. Okay, so let's move to the assumption. So the foreign country here, it's not referred to as only one foreign country. Instead, it's the rest of the world. Okay, so I have a home country. Okay, a home country, and the rest of the world, I treat it as a foreign country. Okay, so this model we are examining the short run. So what's the short run's characteristic? The short run's characteristic we previously said that the characteristic is price is sticky, right? Because changing price it costs a lot, and price have the inertia to stay the same, right? Remember the overshooting model, right? One of the reasons why the exchange rate in the short run will overshoot is because the price of the goods is slowly adjustment in the long run, right? Okay, so now we assume the home and foreign price level, P bar and P star means foreign, right? Due to the price steepness. Okay, so this is a very conventional assumption in the macroeconomic. Price is sticky. So if we say price is sticky, what is the inflation rate? The inflation rate is supposed to be equal to 0 in both home country and the rest of the world, right? Because in the short run, we believe that the price is fixed. The price can move. So inflation rate is equal to 0. So what does it mean? The nominal term, it's always equal to the real term in this world, right? And then we assume the government spending and the tax are fixed as well. Right? And also we assume the foreign output and foreign interest rates are fixed. Okay, so rest of the world's output is fixed, and the rest of the world's interest rate is fixed. Okay, so why we make that assumption is because we believe our main interest is in the equilibrium and fluctuation in the home economy. Okay, so we want to know what's the monetary policy's effect to the domestic market. We could relax this assumption in the future, but that will just make the model become more complicated. Okay, and by applying the knowledge we just learned in chapter 16, the income Y is equivalent to output. Okay, so now the GDP, it's equals national disposable income. All right, so this is a very, very simple way to make the assumption, right? So now GNDI and GNI and GDP, they are the same. Okay, so the growth, the total production of the country, we just assign it as Y. Okay? And we assume what? We assume the net factor income from abroad, net unilateral transfer, right? So those two terms are equal to 0, right? Remember, current account, by its original definition, the finest definition, it's equal to the trade balances in goods plus the net factor income from abroad plus net unilateral transfer, right? So in order to simplify the model, we assume this one is equal to 0. This one is equal to 0. So current account right now refer to trade balance. Okay, so as you can see in chapter 16, we explore all kinds of the finest definition of the national account, right? But when it comes to the economic model, try to make our model's assumption clear, right? We try to clean up everything, like, for example, the foreign income, net foreign income from abroad, maybe just 2% or 3% of the current account. And this one, or even smaller, like 1 or 0 point something percent. So we could ignore it. We just treat the trade balances as the representation of the current account. Okay. So the first part of our goods market, we go back to the consumption. Okay, so consumption, C, is represented as a function for the disposable income. So this term, YD, it's equal to the total income for one person minus the tax they pay to the government. Okay, so this equation is known Keynesian's consumption function. Okay. The slope of the consumption function, so you know that right now, the consumption and Y D is supposed to be like a positive slope. YD increase, consumption will increase. And the slope of this line is called marginal propensity to consume. Some of you might already learn this one in the macroeconomics, undergraduate macroeconomics. Right? So what does it mean? If my disposable income increase 1%, my consumption will increase. Right? So if I use the graph here, consumption is in the vertical asset, disposable income is here. Consumption function should be like this. It's a positive slope line. And the slope here, it's the marginal propensity. Propensity to consume. Right? Whenever your disposable income increase by 1 unit, how much consumption you will increase? Okay, the idea is it's easy. So C and Y, their correlation, it's positive, right? So consumption, it's a function of the income, right? And consumption, it's also the function of this. That's also this. Okay, just remember that Y and D are Y and C are positively correlated. Okay. Secondly, the investment. Okay. So firm's borrowing cost is the expected real interest rate. Okay. So which equals the nominal interest rate? Okay. Minus expected rate of this. What is this equation? What do we call this equation? Real interest equals to nominal interest minus inflation rate. What do we call this one? This is the Fisher effect or Fisher equation, right? Okay. So because we are in a short run, right? We are in a short term. We expect no, we believe that the pi is equal to 0. So what does it mean? The real is equal to the nominal interest rate, right? And we know I, the investment, it's a decreasing function of the real interest rate, right? Means R increase or I increase, you are going to save more, right? So that you invest less. As the interest rate is small, you are going to invest more, right? So by this setting, we know that the investment, it's a function interest rate. Okay, so remember that what is C? C is a function of income, right? Whereas I investment, it's a function of interest rate. And what is the last one for us to compose the GNE? It's the government expenditure, right? So government sector, we have two parts. One is the tax and one is the expenditure. Okay, so we ignore the government's transfer program. Okay, so if tax is larger than the expenditure, we say that government running a budget surplus. So if government spending is larger than the government's revenue, so tax could be treated as the government's revenue. G is government spending, right? And deficits and surplus, it's according to which one it's bigger, right? And in this model, we just assume this is a constant in home country. Okay, What about the exchange rate? So we define the real exchange rate like this. Okay, so we expect the trade balance of the home country to be the increasing function of the home country's real exchange rate. Okay, so what does it mean? Trade balance is equal to export minus import, right? So if the real interest rate increase or real exchange rate increase or nominal exchange rate increase, that will make my currency depreciate against the wall, right? So my currency depreciates so that my export will increase and my import will decrease, right? So exchange rate increase, that will make my trade balances increase. Whereas my exchange rate decrease will cause my trade balance decrease. Right? Use the same logic. If exchange rate drop, that means the currency appreciate. Right? Currency appreciate means domestic citizens have the ability to buy more, right? So the import supposed to increase, but the export will decrease because the cost is going to be higher, right? So depreciation of the currency, it benefits the and increase the export, decrease the import, where the appreciation of the currency is decreasing the export, increasing the import. Okay, so it's here. Okay, so trade balance is the country. It's a function of three things. Okay, so it's a function of three things. One is the real or nominal, doesn't because it's in the short run, right? So this is the real exchange rate. And the disposable income of home country. And this one is the disposable income of foreign country. So three factors will affect the trade balances: exchange rate, current income in the home country, and income in the foreign country. Right. So let's recap. What's the good market? What's the good market? The composite market. Consumption. Right. Consumption, and we know consumption is a function of what? It's a function of the disposable income. Right. And this is a positive function. Means if disposable income is increased, consumption will increase. Right? And the investment, I, it's a function of interest rate. Right? But this one, it's a negative function. Right? Because if the interest is higher, you will try to save your money to a bank instead of using the money to invest. right? To borrow the money from the bank to build up a factory or to buy the new equipment. G is the constant, right? So government spending, it's not related to any of the endogenous variable here. So G is a constant. Trade balances means export minus import related to three things. One is the exchange rate. Exchange rate is a positive term, right? So it's a positive function of the exchange rate. Domestic income is a negative. It's a decreasing function in domestic income because the domestic income is higher. That means the people in home country can buy more foreign goods. Buy more foreign goods implies the import will be higher. Given the other things remain the same, export minus higher import, that the trade balance will decrease. So the home country's income will be a negative term in the trade balances. Lastly, foreign income. Foreign income are going to be a positive term of the trade balances, right? Because if the foreign country's citizens, they have higher income, they can buy the goods from home country more, so that the export of the home country will increase. Other things remain the same. Export increase, import remain the same. Trade balances increase. So this term it's positive. Okay, so um, that will be it for the good market condition. Okay, so let me just recap one more time. Okay, let me. Okay, C and we know this is positive. I, we know this is negative. G, balances is equal to. Right? So this means a function of something. So this is my endogenous variable, right? So YD increase, C will increase. I increase, investment will decrease. Trade balances, okay, E increase, trade balances will increase. So this one is positive term. Y increase, trade balances will decrease, right? Because the home country's citizen, they could buy more goods from outside of the country. So this is a negative term. This one, if, if the foreign income increase, trade balances will increase, right? So this one, they move at the same direction. Okay, so that's what I have in IS curve. This is the good market. Okay, go back to the slides. Can I go back to the slides? Okay, so Okay, so this is increasing, right? And this is decreasing, this is increasing. Okay. And then maybe we could skip this one. Good. Move to the equilibrium. Okay, so now we already construct the demand side. We already construct the demand side. That's C plus I plus G plus trade balances. Okay, and now the supply side is just straightforward. It's just equal to the GDP. So you will see in the equilibrium, supply is equal to demand. Right, so Y is equal to C plus I plus G plus TB. Okay, so if you add all the factors we already discussed into the model, the equation looks like this. Okay, so demand, this is demand, it's equal to this is consumption. Right, and this is investment, government spending, and trade balances. Okay, so what are the factors will affect the equilibrium? See, so tax, interest rate, government spending, nominal exchange rate, domestic income, foreign income, and foreign tax. Okay, so let's see what happens if the demand curve will shift up. Okay, so if the government spending increase or the falls in the tax, okay, so one increase, this one decrease. Why is this one increase? The demand will goes up. The demand is equal to C plus I plus G plus X plus M, right? So if G goes up, demand of course will goes up. Okay, so T is coming from where? If the tax, right? If the tax decrease, the disposable income will increase. So that the consumption will increase. Right? Consumption increase, so that demand will increase. Okay? What about the third one? Fall in the home interest rate. Okay, so I decrease. What happened? The investment will increase. Right? Because you want to, the cost for borrowing the money lower, so you would like to borrow more money from the bank to invest to build up the factory. Raising the nominal exchange rate. Okay, raising the nominal exchange rate. Why? Raise the nominal exchange rate means the currency, home currency depreciate. Right? So depreciate will help the export and jeopardize the import so that the trade balances will increase, right? Trade balance increase, the demand will increase. This one, the raising the foreign prices and fall in the home prices will also cause the demand shift up. Okay, so raising the foreign prices is the same with the raising the nominal exchange rate, right? So because real exchange rate is equal to EPP. So if P star increase, Q will increase, trade balances will increase, so that demand will increase. On the other hand, if the P domestic price level decrease, trade balances will increase, so that demand will increase. Okay? So, the summary, in general, anything shift up in the consumption function will shift up the demand curve. Anything shift up the investment function will shift up the demand curve. Anything shift up the trade balances function will shift up the demand curve. So we introduce the IS curve. Okay, general equilibrium require equilibrium in all markets. That is equilibrium in good markets and the money markets and the foreign exchange markets. So IS curve shows combination of output Y and the interest rate for which the goods and the foreign exchange market are in equilibrium. So if you go back to the equation that we have, this equation actually could represent as Y and I in some sense. Right? Y play a role in C, I play a role in investment, Y also play a role in the trade balances, and Y is also here. So IS curve will be downward sloping in a macroeconomic. So you could treat this as a price for all country. And this will be quantity or output of all country. So this is the first part of the ISLN FX model. Okay, and if we think about the foreign exchange market, UIP is the only one that we need to know here, right? Linear approximation of the UIP one more time. Right, so domestic return, right? This one, acronym is DR. It's equal to the expected return, expected foreign return. That's FR. So remember, we are going to have a foreign exchange market, something like this, right? And remember here, I, the vertical axis, I, the horizontal axis is exchange rate. Okay, so let's take a look of the IS curve. So this is the IS curve. Okay, so IS curve actually derived from like I is equal to plus CA. This formula, right? So IS. So if I have a demand like this, based on all the national accountings I have, right? Like GNE plus TB is equal to Y, right? equilibrium in good market, it's 0.1 double point and 0.2 double point. And this one just shows that it's a Keynesian crossing. That means supply is equal to demand. Y is equal to this. So if I have a fall in the interest rate, okay, so fall in the interest rate, this point, original equilibrium from 1 will move to 2 on the IS curve. Using the demand that we just derived before, the demand will shift up. So the output will shift to the output will increase. Right? So you see the fall in the interest rate will cause the output increase. So I and Y on the IS curve are negatively correlated. That's why IS curve will have a negative slope. Okay, and then if we go to the foreign exchange market, the I decrease. Okay, so the I decrease. This will lower the domestic return curve. Right, lower the domestic return curve. So the exchange rate will increase. Exchange rate increase. Nominal exchange rate increase means the home currency depreciate. Okay, home currency depreciates, the trade balances, right, will be higher. I will higher, so that demand will shift up. Okay, so the linkage should be coming from the IS diagram first, link to the foreign exchange market, go back to the good market, coming back from the IS. This just want to show you, this just want to show you how we derive our IS curve is a negative slope line on yi space. Okay? So IS curve is a downward sloping. It illustrates a negative relationship between the interest rate and output Y. Okay, so if we go back to the supply and demand, right? So supply is equal to the GDP, demand is equal to all of the absorption. If we have a raise in a government spending, okay, usually we call this one expansionary fiscal policy. Raising the government spending, it will shift the demand curve up, and the IS curve will shift to the right. Okay, so all of this factor, fall in the taxes, raise in the foreign exchange rate. Okay, so those two could be categorized as an expansionary fiscal policy. Okay, and this will cause the IS curve shift to the right. Of course, the other variable will play a role as well. So if you have the interest rate, foreign interest rate is higher, and this was higher, this one's higher, this one's lower, then the demand curve will shift up, the IS curve will shift to the right. So anything shift up the consumption, anything shift up in the shift up the investment, anything shift up the trade balances will shift the IS curve to the right. Okay, and the opposite just lead to the opposite direction. Okay, so we done first market. The first market is the good market. And how do we construct the good market? Basically, we're just using the demand equal to supply using Keynesian's idea, right? The supply is equal to the total output. Demand is equal to a bunch of the absorption, right? Then we move to the money market. So this one could be represented as a LM curve. So why does it call LM? It's just left hand side, there's the money supply, and L is the liquidity coefficient. So this equation we should be familiar with this equation, right? So M divided by P, it's equal to Li times Y. Why this is hold? Because people have the incentives to hold the money because they want to transaction, right? And if the interest rate is higher, the liquidity will be lower, right? Because if the interest rate is higher, means the cost that you're holding the money is lower. The cost of holding the money is higher, so that liquidity will be lower. So LN on the IY spectrum will be a positive line, like this. Okay, so now we already have two lines, right? One is IS, one is LM. And vertical S is I, horizontal is R. What's the next step? The next step is we are going to use this model to show what are the policies affect. Okay, so if you don't want to understand anything, at least you need to know in the I and Y space, in the macroeconomic I and Y space, right? Interest rate and output space. At least you need to know LM curve represent the money market, and this one is a positive slope. IS curve represent the good market, and this one represent the this one is the negative slope. Okay, and foreign exchange market is the same, right? We are looking at the domestic return, which is the supply of the foreign exchange market, and the demand of the foreign exchange market is the foreign return. Their equilibrium will be the intersection point. Okay, so let's take a look what's the monetary policy and what's the fiscal policy. Okay, so monetary policy means what? Means the government use the money supplies to change one of the macroeconomic variable. And the most important one will be the interest rate. And for the fiscal policy, the change will usually coming from the government spending or taxes, right? Expansionary fiscal policy means what? Expansionary fiscal policy represent higher government spending, lower tax, whereas contractionary fiscal policy is just the opposite. Okay, so let's take a look of what happened for under the different exchange rate regime. So the first one, so now we have two policy tools, right? So now I could use monetary policy and I could use fiscal policy. Under two exchange rate regime, one is float, one is fixed, right? So we are going to explore what happened if it's, so the first case will be monetary policy under the floating exchange rate regime. Okay, so this is the first one, and then we are going to look at the monetary policy under the fixed exchange rate regime, fiscal policy in float exchange rate regime, fiscal policy in fixed exchange rate regime. Okay, so let's take a look. If I have an expansionary monetary policy under floating exchange rate regime. Okay, so increase in the money supply shift the LM curve down or shift the LM curve to the right. So this will cause the interest rate falls. So as the interest rate falls in the floating exchange rate regime, the exchange rate will increase. Right, and this, the equilibrium shift along the IS curve and output raises. So monetary expansionary monetary policy in floating exchange rate regime will cause depreciation of the currency and the output increase. So this is the most common that we see right now. Every central banks would like to use the quantitative easing policy to stimulate the economy, right? And this is the idea, because right now we are in a floating exchange rate period, right? Okay, what about the monetary policy, expansionary monetary policy under the fixed exchange rate regime? So remember, the fixed exchange rate regime means the exchange rate is pegged on a certain level, right? So increase in the money supply will shift the LM curve down, or shift the LM curve to the right. This is the same. So the interest rate will fall, right? So this is the same as well. So interest rate will fall. As the interest will fall, the lower the interest domestic return, right? The exchange rate will depreciate from the fixed rate. The monetary authority must intervene, reverse the policy, right? But if the interest rate fall to this point, to this level, your exchange rate will be here. But you cannot do so because you are under a fixed exchange rate regime. So you are going to shift back your monetary policy. So your monetary policy, expansionary policy, first come here, you are going to shift back. So the new equilibrium will be the same. Right? So monetary policy under the fixed exchange rate regime is useless simply because under the fixed exchange rate, if you lower your interest rate due to the expansionary monetary policy, you will have the pressure to depreciate your exchange rate so that you are going to intervene. Excuse me, you are going to intervene so that you are going to take back the money that you put into the market. So the interest rate will be higher again, and LM curve will shift back. So the equilibrium 1 is equal to 2. That's at the same level. Okay, what about the fiscal policy under the floating exchange rate? So remember, fiscal policy means what? Means either you increase the government spending or you decrease the tax, right? And expansionary fiscal policy means you shift the IS curve to the right. Okay, so if you shift the IS curve to the right as an increase in government spending, shift the IS curve to the right, your interest rate will goes up, right? Under the float exchange rate, what happened to your exchange rate? Your exchange rate will decrease. Your exchange rate decrease means your currency appreciate against the foreign currency, right? And then if you go back to the ISLM curve, then the output will increase, right? Equilibrium shift along the LM curve. So fiscal policy under the floating exchange rate work. They will make the output increase and the exchange rate decrease. What about the fiscal policy, the expansionary fiscal policy under the fixed exchange rate regime? So let's take a look. Firstly, increase in the government spending shift the IS curve to the right. Right? D increase, D will increase. D increase, the IS curve increase, shift to the right. Right, so originally your IS curve is here. Shift to the right, here. Okay, so now raise the interest rate. Originally your interest rate is at 1. Now your interest rate supposed to be here. Okay, and raise the domestic return. Okay, so because your interest rate is higher in the foreign exchange market, your domestic return is higher. Right, but you are in the fixed exchange rate regime. Right, so you have the pressure to put your exchange rate back to your original level. If you didn't intervene, your exchange rate will drop. So you will have appreciation pressure. Right, so exchange rate will tend to appreciate away from the fixed rate. The monetary authority must intervene. Okay, so how do they intervene? They use the monetary policy to counter the effect of the fiscal policy, right? So you have to shift the money supply to the right as well, so that you will lower down the interest rate. Okay, if you lower down the interest rate, the domestic return line, go back to the original domestic return line, then the exchange rate will go back to the original peg level. Right? But what is the output change? The output will raise dramatically. Not only to the original
the first stage of the IS equilibrium will also move to this point.
Okay, so in a summary, if you are in a floating exchange rate regime,
Monetary expansion policy will always work, as well as the physical
expansionary policy.
The only difference is the exchange rates change are different direction. Okay, the currency depreciate or appreciate, it's different.
But they all have the stimulus effect. Whereas if you are under the fixed exchange rate regime,
Which right now it's not a common it's not a common exchange rate regime right now. Monetary expansionary policy
does not work.
it will not help your output.
Okay?
But physical policy will have the double effect, right? You need to increase IS shift to the right, and then you need to use LM shift